Good morning, everybody. I'm Christopher Golding. I'm the Senior Investment Manager in the Jersey office, and I'm joined today by our Senior Strategist, Daniel Casadi. It's quite important, just a bit of a sales pitch right at the beginning. So many firms that you'll come across will have a Chief Investment Officer. Evelyn Partners is slightly different insofar as the Senior Investment Managers work alongside a strategy team and who provide the framework to lay out our investment strategy. So we're able to work more closely with our clients and bring the right strategy to them. But after such a tumultuous year, being in 2022, being fed by inflation, wars, oil price hikes, interest rate hikes, we thought it'd be an opportune time to speak to Daniel to look back, not only look backwards, but to hopefully look forward with a glass half full. So Daniel, obviously 2022 was a difficult year. Are we seeing the same for 2023, or is there light at the end of this tunnel?
Well, I think thanks for the intro there, Chris. So yes, I'm the Chief Investment Strategist at Evelyn Partners. And yes, there is light at the end of the tunnel. And our key theme for this year is play in the field for yield. By that, we mean look out for higher dividend yielding stocks, particularly in the energy materials sector. And our fairly optimistic view on equities is predicated on three arguments. One is that we think that the Federal Reserve, the US central bank, will pause on interest rates. That gives an opportunity to pick up these high dividend yielding stocks. It's also opportunity to pick up some bonds moving out in terms of duration. Second thing is we think that the company earnings may surprise on the upside. What we do find this year or last year was that actually earnings actually held up fairly well, and that's because companies are able to raise their prices with their corporate pricing power in this inflationary environment above input costs, and that's kept profit margins fairly high. And then the third one is really about the wild card, China reopening. We think that China is set to reopen in a big way. We saw the demonstrations late last year, and that really was a shake-up for the Chinese leadership to open up their economy. So here I'm going to talk about our presentation in three parts. The first part is looking at the macro and market review from last year. As Chris said, it's a tumultuous period. The second thing is looking at the macro market outlook, looking at the headwinds, the tailwinds, and why we remain fairly optimistic on equities. The third part is looking at the strategy, and we think there are 5 areas that are core themes that we think that you should be looking at. So first, I'll just sketch out what happened last year in numbers. Most of these market performances are in sterling terms. So as we know, last year, the All Country World Index, that's global equities, it had its worst return, down 7.6% since 2008, led by the US, emerging markets, Europe, not surprising with what's going on in Ukraine. Big standout was the UK. It was the only major developed market to be positive. And just to add a bit more flesh on the bones there, we saw that the UK outperformance versus the rest of the world, nearly 17%. Now that was the biggest gain in terms of outperformance since 1990. Third point here is looking at the gains in terms of style, so the sort of value areas of the market, the energy materials, healthcare, consumer staples, stuff that you need in everyday life, greatly outperformed the growth areas of the market, where you find the so-called US mega caps like Amazon, Microsoft, etc. And this was the biggest outperformance since 2000. Dividend yielding stocks also had a big outperformance, the biggest since 2000. And it's one of our central themes. In terms of the sectors, energy, the best performing sectors, the growth areas like communication services, consumer discretionary IT were by far the worst performing sectors, a big vast difference there. Best performing UK stock really was about defense, BAE Systems, and consumer discretionary Ocado was the worst. We see gilts and bonds having a terrible year. UK 10-year gilts, worst performance since 1974. And get this, we saw that US 10-year treasuries in dollar terms, the worst performance, down 16% since the Constitution was ratified all those years ago in 1788. So it's not multi-generational, it's a multi-century difference here. So it really was a quite significant event. And another standout stat was at one point during the middle of the Truss government mini budget, we saw 30-year gilts down 52%. At one point in time, that was actually worse than Bitcoin. So think about that for a second. It's very sobering. Uh, Investment grade, they were dragged down by conventional bonds. They had a terrible year as well. We also saw a sort of 60-40 equity bond portfolio. It had its worst performance since 1931, even worse than the global financial crisis. That's when bonds actually performed. But this time around, we saw equities and bonds both going down. Commodities were on a tear. We saw that gold, we'll touch on that later on. They were basically flat, but we saw other asset classes like copper within commodities, that was weak. It was worth bearing in mind that if you look at natural gas in the UK, at one point it was up almost 280%. By the end of the year, it was only up 9%. Hopefully that will feed through to our gas bills. And coffee, so that was down 19, orange juice up 76. So I guess it's short caffeine, long vitamin C. Gold, we see that this was a huge increase, and we'll touch on this later. Central banks bought 673 tons. That's the biggest increase for those first 3 quarters of the year since 1967. US been running down its oil reserves, lowest since 1984. We saw the dollar appreciating quite sharply, up 8%, and we saw that the pound in Asian trade at its lowest ever level. Just to go back to 1985, when it had a similar sort of level. That was after the mini budget, but of course it's bounced back quite sharply up to 124. Who would have got this? The Russian ruble. It actually gained 12% during last year, and that's because of a huge current account surplus. And of course, that's due to higher energy prices and less imports. We saw cryptos had a terrible year, down nearly 70%. Elon Musk, he lost $130 billion. No need for whip round, he's still worth 130 billion, but he's now the world's second richest man. Inflation, US, it peaked at about 9%, higher since 81. It's now starting to come down ever so gradually in the UK. But these are the highest levels we saw in the early 80s. We saw the Federal Reserve raising their interest rates at the most aggressive way in terms of increments since 1977 to 80. And this is probably the most well-telegraphed recession in the US in history. Virtually everyone or the bulk of economists expect a recession in the US. How much is in the market? Bad news for the UK. We have mortgage rates going up, cost of living, and now the tax take's going to be even the highest since 51, 52. Global population hit 8 billion, new milestone. We had the last Boeing 747 after 50 years of continuous production leave the production line. And some of the key words that we saw was, not surprisingly, Ukraine, and then Queen Elizabeth. Last year it was Afghanistan. The biggest search line was Wordle. So just moving to the second part of the presentation, why we remain fairly constructive on equities. As I said earlier, it's the Fed pause, China reopening, and the fact that the earnings are still very, very okay. We have headwinds and tailwinds. The headwinds really is about the monetary tightening, how aggressive the Federal Reserve will raise interest rates. Recession fears, that's the big one. US may or may not get into recession. UK is probably there. Eurozone may just get into recession as well. The mega caps have been a drag on the overall market. We can talk about the geopolitical uncertainty. As we know, the events that we saw in Ukraine, not only the humanitarian issues there, but the fact that what this really illustrates is there's this stark difference now between the so-called autocracies, which includes China in a shotgun marriage with Russia, OPEC, maybe India and Turkey in that one, and also the West. So looking at Europe, US, and Japan, for example, there is this stark difference. And what that means is not only do investors probably want a geopolitical premium, but it does mean over the longer term, this whole idea of trust between those two areas where you have lots of offshoring and capital recycled back from OPEC and China back to the US, that looks less likely after Ukraine and these sanctions that they imposed. The tailwinds is that the US economy can possibly avoid a sharp downturn. There's still nearly $2 trillion of unspent money from the pandemic in terms of handouts from the government, money that just simply hasn't been able to be spent. Also, the labour market still remains fairly buoyant, so any sort of downturn in the US could be quite shallow. We see that China's stimulus, they've already pumped lots of stimulus in. It's just that they've been on lockdown. So once we take out those lockdowns, that stimulus will allow the shovels to be put into the ground to get the infrastructure spending going. So China could be the big avenue of growth this year. And certainly some of the economists are revising up their growth estimates for China. As the second largest economy, it could alleviate any sharp downturn in the global economic growth environment. Equities tend to rally when the Fed pauses. We have looked at the last 6 Fed pausing cycles, and equities rally. The S&P 500 rallies 18% after the next 12 months. We see that valuations and investor positions are still quite favorable for stocks. So P's a lot cheaper than what they were. So this, when we look at the headwinds and the tailwinds, we think on balance, the tailwinds will win out. And that's why we think it's an opportunity to get back into equities or expect them to recover if you're still in them. In terms of the strategy, I'm just going to focus on 5 areas. There's lots of macro uncertainty out there. The balance of probabilities between sharp downturn and shallow downturn or no downturn is quite vast. A lot depends on energy prices, of course, and what's going on in Ukraine. So the key message here is look for dividend yields, particularly those that are supported by cash flow yields, decent cash flow yields. So the first one is plain feel for yield. This looks at areas with decent cash flow. Of course, this includes the energy sector, materials sector, where the pricing power is very strong. Utilities and staples also have decent cash flow. This should support dividends, limit the room for these to be cut. Stick with the UK. It's got the highest dividend yield. US has got lower dividend yield. Second theme is there's still elevated risk in the mega caps. We're not going to completely write them off. We just want to see more evidence that the Federal Reserve has done all of the heavy lifting in terms of raising interest rates. We have another meeting in early February. There is an opportunity to come back in these ones. We just want to see some more evidence and also some recovery in their earnings. So we would just say there's a lot of risk in those mega caps. In terms of the third theme, it's really the tilt towards Asia. As I said, we've got the China reopening, which is a central theme for this one. We have the dollar going down, and Asian markets tend to do better with a weaker dollar. It means that the amount of dollar debt they have is easier to pay. The valuation is a lot cheaper, so it's a good entry point. And we are seeing China, MSCI China, rallying very, very sharply at the moment. We are thinking in terms of our fourth theme to add a little bit more bond duration. As I said, we're near the end of the Fed hiking cycle. That's the central part of our thesis. A lot of the heavy lifting has already been done. So it's worth thinking about after a terrible year for bonds to start going in at these higher yields. We think this is an opportunity to add a little bit more bond duration. And then the last theme is really talking about dollar depreciation and gold appreciation. The first thing is that when we look at the dollar, we see that some of the geopolitical concerns actually works against the dollar. I'll go into that in a second. We also see that the US has a huge trade deficit that needs to be funded. And of course, as risk appetite increases, people move away from the surety and safety in the dollar and start to invest in risk assets like equities. Gold is, it really does what it says on the tin. Basically flat performance last year. That's good. Given that bonds were down 16% like the US Treasury market. So it did what it said on the tin in terms of providing that disaster insurance. And there's a new structural demand driver coming from a foreign official central banks, and I'll talk about that in a second. So what I'll do is I'll just go through a slide or two for each of these central themes. When we look at the first one, playing the field for yield, we notice that high dividend stocks are supported by higher commodity prices. We had this large period of time since about GFC where the all country world index high dividends against the rest of the world have been a significant underperformer. And it's only now started to turn around because commodity prices have been higher. And there's been this rotation away from these growth parts of the market in the rest of ACWI and into these high dividend stocks. And these are supported by higher commodity prices that supports energy and materials. In terms of which specific sectors, just to drill down a little bit more, we can see what I've done on the left-hand side is look at the forward dividend yield, which is in red. And the blue one looks at the forward cash flow yield. And the green line just looks at the average. And what you can see is if you look at the cash flow yield for things like energy, it's very, very high at the moment, along with utilities and materials. So that gives you more surety that these dividends can be supported. And if you look at the left-hand side of that chart, you can see that the sort of growth areas of the market, like IT, consumer discretionary, consumer service, communication services, have much more lower dividend yields and less cash flow to support them. So we think in terms of the risk, you probably want to add a bit more of the dividend yields in this still highly uncertain environment. But if the macroeconomy starts to improve, the Fed pauses, there will be an opportunity to go back into these growth areas of the market. In terms of how that splits out by geography, the chart on the right-hand side shows you that the UK is in terms of dividend yield, is the highest ranking, US at the bottom, and also the UK also has very high cash flow yield. I know if you look at the UK economy, it looks disastrous, strikes everywhere. But remember, 75% of the top listed companies' sales are derived overseas. So the domestic economy doesn't matter as much as what goes on overseas. The UK really is a global market. I'm just going to talk about the second theme here, which is really talking about the risk in mega caps. What we've got in this chart is really looking at the mega caps performance to the rest of the S&P 500, so the other 494 stocks, for example. And what you can see from that red line is basically the price performance went down to the level of the company earnings. And that's really where we are at the moment. We are seeing that the mega caps earnings are starting to weaken. Essentially, the mega caps are really are based on a lot of advertising revenues. And we probably need to see, one, the Fed pause coming through and basically a recovery in some of those earnings. Next slide, please.
Sure.
The next slide is just looking at the other element, which is looking at interest rates of the mega caps against real 10-year yields. Real 10-year yields are inverted on the right-hand side, and it just shows you we need to see that recovery and becoming less negative less positive to help the mega caps performance. You can see how the mega caps have been performing along with that rise in real yields that was driven by the Federal Reserve raising interest rates. On the next slide, looking at the third theme, this really looks at our thesis about why we like Asia, and it's really predicated about China reopening. And you can see that chart on the right-hand side. We can see that China started to recover very, very sharply, and it's now starting to bounce back. Asia has been dragged down overall by China, although offset to some degree by India. But China's the big market. You need China to recover for the Asian equity market to outperform the rest of the world. But if you look at that chart on the right-hand side, we can see since that reopening announcement and the fact that the dollar has started to weaken, we are starting to see Asia start to come back in a big way. On the fourth theme, just looking at why we like bonds, this chart here looks at the US 10-year yield, and the red line looks at what the Federal Reserve projects in terms of the dotted lines. So the FOMC, their interest rate forecast, and I've just added it to the interest rates for the short-term interest rates. And what you can see is, looking forward, the FOMC is projecting that interest rates should start to come down, and that gives you an opportunity for bond yields to come down as well. So the upward trajectory that we see in bonds is probably over, and that's one of the key reasons why we like bonds and why we think that you should add a little bit more bond duration to your portfolios. And then the final theme is really talking about dollar depreciation and gold appreciation. And what I want to show you in this left-hand side is really about some of the geopolitics. Normally, geopolitics, when there's uncertainty, it tends to lead to the dollar appreciating, but it could happen the other way around this time, because what we can see is when President Xi went to see the Saudi Crown Prince Mohammed bin Salman, it did seem to be a lot more handshakes. When Joe Biden went there, it was more fist bumps. And what we did see was when Joe Biden asked the Saudis to increase oil output ahead of the midterm elections, they did exactly the opposite. They cut 2 million barrels a day a couple of months later. So it just tells us why are they doing that. I guess if you're looking at it through a Saudi lens, you can see that actually the Saudis recognize that the West wants to reduce our usage of fossil fuels, and he knows his biggest customer is really the Chinese. And you can see that chart on the right-hand side. It basically shows you the trade that Saudi does with China and the trade that Saudi does with the US. So it's pretty obvious, looking at a longer-term basis, that the Saudis probably want to do more trade with the Chinese. And that may mean that we move away from this so-called petrodollar, where the Saudis have been exchanging their trade surplus back into the US. And instead, they may start to use a petro yuan. There's lots of talk about this, where basically the Chinese will pay for Saudi oil in renminbi and cutting out the dollar and demand for the dollar in that environment. So I think this is a longer term argument to suggest that actually the dollar could start to weaken over a longer term basis because of this breakdown of the autocracies and democracies, and the fact that US has a large trade deficit. I also think that with the Fed moving to pause on interest rates and the rest of the world starting to raise rates more aggressively, I'm thinking the ECB, there's less need to hold that dollar as risk appetite improves. And then that slide 16, I just want to give you a little bit story about gold, why we like gold so much. The chart on the left-hand side looks at the gold price in red, and it's really gone on a tear recently. And the green line looks at the gold price if it was priced according to real interest rates. There's a very tight correlation, or has been, with real interest rates and gold price. That basically means that for a zero yielding asset like gold, there's an opportunity cost of owning bonds rather than gold. And normally that's been a key driver of the gold price, but it's completely broken down in the past year. And I think a lot of that has to do with the relationship we have between the sanctions that the West imposed on Russia. One of them in February and March was the confiscation of the Russian central bank foreign exchange reserves. What that essentially meant was, or an indication to the rest of the world, that if you want to recycle your money into Western financial systems, think again. And that's why countries maybe like the Chinese will probably want to recycle more of their money into owning gold within their own national borders, so the less risk of these secondary sanctions. And that's really what this chart on the right-hand side, if you remember earlier, I was saying that gold demand from foreign central banks has been high since '67. You can see that with this chart on the right-hand side. There's been this new structural demand driver going for gold. If you look at how much gold has ever been mined, it's about 200,000 tons, and 17% of that is owned by foreign central banks and sovereign wealth funds. We think that share of the pie is going to increase. Not only does gold give you that disaster insurance and proven to be so, but I think this new structural demand driver with a weaker dollar helps it. Remember, as the dollar goes down, gold becomes cheaper as it's denominated in dollars. And then finally, just to wrap it up, Chris, just playing the feel for yields, our key theme for this year. We can see that there's plenty of risk in the mega caps. We like the tilt towards Asia ex Japan and add some bond duration. We think the dollar's going to go down further and gold goes up. And just thought I'd highlight, don't be caught out of position in 2023. So that's not me in a stormtrooper suit, by the way.
Thanks very much, Daniel. I mean, I guess that the message that we're getting, certainly from the strategy team, after the US has outperformed the rest of the globe on a 12-year basis, now's the time to relook at positioning and diversify away from some of those mega caps, take advantage of the uptick in yields, to add to your bond allocation, lock in some of those higher interest rates through that. Also diversify portfolios using gold. I mean, the reason why we have gold in portfolios is the negative correlation against the other assets classes, hence the diversification benefits. But I guess the big question is, Daniel, is what's going to happen to US interest rates? When are we going to move from this hiking phase to the pause phase? And going to roll that out, that question also to the Bank of England and the ECB. And do we need a recession this year in the US to help bring that inflationary sort of fears down?
Well, just if you can go to the next slide, just for the compliance who want to see this. Yeah, so you just gave a great summary of our position within the strategy, what we're feeding through to the fund managers at Evelyn Partners. But in terms of the question about when do we get to the Fed pause, I think we're getting very, very close to it. What we are going to see is that the Fed is going to raise interest rates by maybe 25 basis points, which is a step down. And then we might have one more in March, perhaps. And that's about it. The reason why is, number one, we see that the inflation data is starting to come down. A lot of the commodity prices have come off a little bit. And also we are starting to see some of these supply chain concerns being alleviated. It's also worth bearing in mind what's happening in the labour market. It does look fairly buoyant at the moment, but we are seeing some high profiles, redundancies coming through. I think the Federal Reserve will be cognizant of that, and also the fact they've done a lot of the heavy lifting. The big question mark we have about the Federal Reserve is if Jay Powell thinks he's Paul Volcker and he just wants to keep raising rates aggressively. That's not our central theme, but that would be a key risk. In terms of whether you need a recession to bring down inflation, I think the economy is slowing down quite significantly anyway. If you look at the consensus, it expects growth of about maybe 0.5% for this year. It's not that much. I mean, so the demand side of the equation is really helping. the supply side of the equation is starting to come through. And I think when we look at China, if it's now that it's reopening, it means that there's going to be more of those manufactured products coming into the system, and that could alleviate some of the further pressures on goods prices. Keep an eye on rents. That's the big one. If they need to come down to bring that inflation level down as well. And everything I said about the US really sort of translates into the UK. The UK just has a worse demand side story there. We probably should expect about 1% contraction in GDP this year. We are seeing us at the UK having much higher levels of inflation. It's going to be a little bit more sticky. The wage pressures seem a bit more acute in the UK. Striking is not helping in terms of getting supply of goods into the shops. So I think the UK probably has a bit more of an inflation problem, and maybe the Bank of England is probably likely to be lagging in terms of going towards that pause. So you might expect the Bank of England raising interest rates a bit longer than the Federal Reserve, and the same goes for the ECB. Remember, the ECB is very, very focused on the actual inflation data rather than employment. So the situation here is that the Fed pauses first, dollar comes down, and then we probably have pauses later for Bank of England and ECB later in the year, which means that their currencies will probably appreciate and fits into our dollar depreciation theme.
Excellent. Thanks, Daniel.